Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. On the last two episodes of this podcast, we discussed the macro and the equity market outlooks. This week we turn to the fixed income market. To chat about the outlook, we are pleased to be joined by Prerana Seth, our fixed income strategist. Prerana, welcome back to this program.
Thank you, Kishore. It's great to be back here.
Prerana, there seems to be a lot going on against the bond market these days. Bloomberg Global Aggregate Bond Index declined by circa 7% in the third quarter this year, taking the year-to-date losses to 20%. This has been the worst performance of the index to date, and the volatility rose sharply. We've been underweight fixed income in our asset allocation, but what is the outlook now? Also, in terms of the duration, do you still advocate a long duration stance?
So the third quarter saw a shift in narrative from lower for longer to higher for longer rates, with inflation turning out to be more persistent. Going forward, we believe that the bond markets will continue to face volatility, but this volatility is less likely to do with inflation volatility in our view. In fact, it will be policy-related uncertainty, which is likely to be a key risk for the fixed income assets. A more hawkish Fed completely ignoring downside risk to growth has further raised the risk of policy error. Data-dependent Fed may not be able to perfectly time the dovish pivot given its reliance on inflation data, which tends to lag current price pressures. And hence, higher policy uncertainty means that there will be more pain and volatility in the short-term rates. In terms of the long-term rates, we believe that the upside in long-term rates will be limited as they are likely to remain anchored to the long-term neutral policy rate. Despite an aggressive Fed stance, the Fed has actually not made any upward revisions to the long-term neutral rate. In fact, pre-pandemic factors influencing the long-run neutral rate for the likes of inequality, demographics, higher savings rate could come back into force once the pandemic-related disruptions start to fade. So a faster and aggressive Fed action will only accelerate the pace of return to the long-term neutral rate, and hence we still advocate a long duration stance with a preference for 7 to 10 year US Treasury segment.
Well, that makes sense. Now let's move to the higher risk side of the fixed income landscape. Tightening liquidity conditions and rising recession probabilities have brought certain credit hotspots from within European banks and emerging markets to the fore. How are you reading these developments? Also, given these recent flare-up in credit risk, how should investors position?
So credit concerns, they have risen sharply for some segments of the market, but this has been more so in Europe, UK and emerging markets. Concerns over Credit Suisse is one example in European credit, and also in emerging markets, Egypt's sovereign concern is an example. But European credit has been under pressure the most with the rising probability of recession in the region. On the other hand, US credit spreads have actually not widened as much compared to European spreads. Also, US financial conditions have not deteriorated to the same extent yet. But during periods of heightened bond market volatility and recession concerns, it is not surprising that we get to witness sudden and frequent flare-up of hotspots in both corporate and sovereign credits. While these concerns are likely to be more idiosyncratic and less likely to be systemic in nature in our view, frequent occurrences explain our preference for quality assets at this juncture. So in developed market corporate credit, we are neutral on US investment grade and European investment grade, but underweight on US and European high yield. In emerging market also, overall we hold a neutral stance on emerging market dollar sovereigns, but with quality tilt towards high quality GCC and also Oman. We remain cautious on weak emerging markets with the likes of Egypt that stand poor in terms of their external positioning.
Prerana, thank you very much for joining us on this podcast and helping us understand the dynamics of the bond market, which has presented difficulties to investors so far this year. We hope the outlook improves.
Thank you, Kishore.
Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. My name is Kishore Muktinutalapati, and you were listening to the Global Investment Insights podcast brought to you by ADCB Asset Management.